Okay, there are no V's or W's. The alphabet soup doesn't apply in the current market recoveries. What we're seeing is patterns of behaviour, and patterns are reflecting the psychology of the market, whereas V's and W's reflect economic factors. So in terms of psychology and the Dow, what we see is an inverted head and shoulder pattern, and that gives us a projection target of 11,600. Doesn't mean we'll move all the way straight to it, but in the longer term, that's what the target is, and we seem to be moving towards that level to some extent. When it gets to 11,600, then it is uncertain as to what will happen. We're not too sure whether the market will pull back from that, whether it will consolidate, whether it will continue the uptrend.
Right.
But the behaviour of the US markets is different to the behaviour in markets in the rest of the world.
And that's because?
I'm not too sure why it is because, but we can clearly see the behaviour in the chart. I mean, I have some personal feelings as to why it is because,
right.
But that's another question. If we look at Shanghai market, what we see is that first of all, the market behaviour of recovery led Western markets by about 3 months. So it's moving much more rapidly and has since November 2008. In terms of the China market, what we had was a major pullback in terms of price, in terms of the trend, followed by a sideways pattern, and we had what's called a cup and a handle pattern develop. We're now broken above that. It gives us an upside target of 3,400, followed by a 4,200 target.
Right.
So that tells us that the strength and nature of the China recovery is different to the strength and nature of the recovery in the US. I don't really give consideration to that at all. My method of analysing the market is to understand the inferred behaviour of traders and the inferred behaviour of investors. Obviously in Western markets, our investors are large-scale funds and fund managers. In the China market, the activity of funds and fund managers is also exceptionally large. Not as large as in the West, but it is a substantial foundation to all trending behaviour. So the analysis applies across all markets. If you want activity, if you want volatility due to day traders, you go to the US or you go to Australia. The reality is, you cannot day trade in China. You cannot buy this morning and sell this afternoon. You must buy today and sell tomorrow. So that takes some volatility out of the market. So when we look at volatility in the China market, part of it is driven by the fact that the market will lock limit up or limit down. In other words, it can only move 10% per day. So price is going up and there is frustrated demand, I can't buy because it's locked limit up, then that will lead to an increase in volatility on the following day. We can take the upward trend as a given in China, and the reason for that is that the pullback in price and time has successfully tested support at around the 3,000 level and then moved up. We have yet to see a successful retest of support at 10,200 in the Dow. If that develops, then that will tell us there is continuation moving up. In terms of the Chinese market, institutional support is very strong. In terms of the Western markets, in Dow and S&P, institutional support is still relatively weak. And we know that because, using our own technical indicators, the degree of separation in the long-term group of moving averages is still relatively narrow. That tells us that investors are not piling into the market, they are still cautious.
So that in itself is a reason for optimism?
I would prefer to see a wider separation, because what that tells us is that when the market pulls back, that investors will come into the market as buyers. And that's one of the key relationships we're looking at. When the market retreats, are investors also running, or are investors there as buying? When there's a wide separation in the long-term GMMA, it tells us investors are there as buyers. At the moment, in the Dow in particular, the separation is not very wide, it's still relatively weak. Only after I've put my money into the bank. Once I've collected profits, that's usually enough lag for the economic fundamentals to start to appear in the market. Markets leave the economic fundamentals by about 4 to 6 months. So by the time the fundamentals come out, the event has already happened. You're still working in a new environment. So I use fundamentals as a confirmation of what I'm doing, not as a reason for what I'm doing.